Greetings, everyone. I'm David Darst here to recap the month of November, and quite a month it was. First of all, you had the election, presidential election in the United States. President Trump, President-elect Trump, got 76.9 million votes, and Kamala Harris got 74.4 million votes. So the Republicans captured the White House. They also captured the Senate. Their vote margin is narrow. 53 Republicans, 47 Democrats in the Senate, and in the House of Representatives, it's 220 Republicans to 214 Democrats in the House of Representatives. So I would emphasize, as we go forward, that this is a narrow majority, and it's possible that some of the Republicans, to get what they want, could split off, and therefore some of the agenda might not be able to be passed. So markets at one point during the month of November began to worry about this. As the month rolled on, those fears, those anxieties began to calm down, and markets basically continued to be priced for growth, for falling inflation, and for the Fed cutting, although the Fed's probably going to be cutting at a slower pace than people had been anticipating earlier. Markets are priced right now, financial markets, for calm and for new directions. In the equities, U.S. Public listed equities, the month of November was up 5.7%. That's the best month of the year, and it's up 26.5% thus far this year. The NASDAQ, 6.2% for the month. It was also the best month of the year, up 28% for the year. The Russell 2000, which, as you know, is the small and mid-cap companies. We've talked about this many times before. It was up 10.8%, and that represents half of the total gain that they've accomplished thus far this year, up 20% for the year. November was a very big month, as I think you saw the resurgence and the return of animal spirits. That's where people get into an even more positive mood than they had been before. The bank stocks, the KBW Bank Index, was up 13.7%, also the best month of the year, and it's up 43.9%. As you know, the banks, financials have been an area that we have emphasized over many, many years. NVIDIA, that one slowed down. It was up 4% for the month. It's up 179% for the year, of course. But that artificial intelligence enthusiasm seems to have slightly diminished a little bit. Oil was down 1.8%. It's down 5.1% year to date. Gold, of course, down 3%, and it's up 28.8% year to date. The two-year Treasury, now that's an indication of the Fed's likely monetary policy stance. The two-year Treasury during the month was down 3 basis points. Year to date, it's down a total of 10 basis points. So you closed at 4.13%. The 10-year, which is an indication of economic growth and of inflation outlook, 10-year closed at 4.18%, the 10-year Treasury. That was down 10 basis points, and the 30-year was down 11 basis points to 4.36. The dollar, despite interest rates going down, you would expect the dollar to be going down. Despite interest rates going down, the dollar was down 1.4. It was up 1.4% for the month, and it's up 4.3% for the year. The current market pricing of the Fed Watch tool of the Chicago Mercantile Exchange right now is looking at a 70% chance of a 25 basis point cut on December 18th. That's the last Fed meeting of the year, December 17th, 18th, and a 30% chance of no cut. We are in the camp of most likely a 25 basis point cut. Wrapping up here, you've got fundamentals, you've got valuation, and you've got psychology. Fundamentals continue to be strong. Walmart stock is up 70% thus far this year, whereas Target stock, which is a competitor of Walmart, they're much smaller, of course, is down 12% year to date. this indicates that shoppers have been much more discriminating and discerning in their purchasing activity, but they still are out there shopping. We will see how the holiday season unfolds as we roll through December. Retail sales have been pretty strong. They were kind of going side by side. They were stagnant for a large part of this year, but they've recently begun to pick up. The ISM services sector, that index, has been well above 50, which means it continues to expand, whereas the manufacturing has been lumbering along, very sluggish, and it has been in more of a contractionary mode thus far this year. I think that comes back to the political. You expect to be higher tariffs, at least the threat of tariffs. You're going to have lower taxes. You're going to have lighter regulation. You're going to have an emphasis on government efficiency and restoring manufacturing capabilities and capacity in the United States. These will be the 5 themes, and I think those themes have been picked up. Valuation, all the measures of valuation. Price-earnings ratio, Shiller price-earnings ratio, Tobin-Q ratio, the Buffett ratio, the equity risk premium. All of these 5 measures of valuation, you're in the 95th and above percentile historically. So we say things are going along well, but be careful. Valuations are quite high. And then we get into psychology. You've had a big surge in crypto and in sort of associated investments. You've had heavy inflows into equity mutual funds and ETFs, and also concentration, which we've cautioned against that. The U.S. is at a 75-year high as a percentage of the total stock market of the total world. So things are going well, but let's say, and this drives us, as you've heard before, for alternative investments, private equity, private credit, private real estate. Liquid credit, yes, we like credit, but we think you need to be looking at private credit to get that improved yield and improved, I think you can have an improved capital position in the capital structure. With that, we wish everyone a great final month of the year, and we look forward to catching up with you very soon.